IVM.
So SPIVA stands for S&P Indices versus Active, and it is a range of scorecards that measures the performance of actively managed funds against an appropriate benchmark, and that will be very important as I will explain why you have to be very careful in selecting the particular benchmark that's relevant. So the key takeaways across regions that we tend to observe is that first of all, short-term results can be volatile. So even in the largest categories, which is the U.S. large cap equity, which is, that is our flagship category. Over the past 21 years, that changed is that the share of professional investors have increased tremendously at the expense of small-time individual traders. And one of the three key drivers of performance for active is exactly the level of professionalization of the industry or of a given market. Because higher the share of professionals in any single market, the harder it gets to outperform. And to understand that, what you have to consider is that in any market, the alpha of one player can only come from the underperformance of other players. Right, because in totality, all actors or all participants in the market by definition own the market as a whole. And if it's all professionals competing against each other, then the ability to extract alpha from another very well trained, very hard working player who has access to instantaneous information just like you are gets increasingly difficult.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, I am thrilled to welcome back on the show S&P Dow Jones Indices, my guest Benedek Boros, Director, Index Investment Strategy. We're going to talk about passive investment in India, factor investing, and much more. Regular listeners, you'll obviously recall that we had Koil Ghosh, who was then with S&P Dow Jones Indices back in 2020 and 2021. Man, sometimes I feel I'm doing this for really too long. Benedek, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thanks very much. It's a pleasure to be here.
And welcome back to India for the third time.
Thanks. It's always good to come back, and every time I come back, it's just great to see the development of both in the passive space, but also in the country in general.
First off, you just tell our listeners something about S&P Dow Jones Indices, what it does, etc. Because S&P itself is a huge company, and S&P Dow Jones Indices is part of it. Just let's start from there.
That's right. So S&P Dow Jones Indices is part of the S&P Global company, but our division in particular maintains a range of benchmark indices which first measure the performance of markets around the world in all asset classes. So in addition to equity indices, we have a range of indices for fixed income instruments, for credit instruments, for commodities, for things like emissions, carbon emissions in markets where they exist. And we strive to provide transparent benchmark against which active managers can measure the performance, but also analysis and research on the drivers of performance for our indices. So my team in particular, Index Investment Strategy, is responsible for providing research and commentary for all asset classes, and also we are responsible for producing the SPIVA scorecards for 9 regions around the world.
Which is what gets me to the SPIVA report, right? So first off, if you could just give some background to our listeners as to the history of SPIVA, what it stands for, and then let's start from there.
Yeah, absolutely. So SPIVA stands for S&P Indices versus Active, and it is a range of scorecards that measures the performance of actively managed funds against an appropriate benchmark, and that will be very important as I will explain why you have to be very careful in selecting the particular benchmark that's relevant for a given fund. This range of scorecards started to be published over 20 years ago in the US. So in the first scorecard, we measured one region and one category within the US market. And as demand increased for passive investing and index-based indexing around the world, we rolled out the scorecards into 9 regions in total. So currently we cover, in addition to the US, Canada, Latin America, Europe, Middle East, South Africa, Australia, Japan, and India, of course. And we also expanded the range of coverage across categories. In Europe and the US, we report on dozens of different categories, ranging from large, mid, small caps, growth style, value style, different segments of the fixed income markets. But in less developed markets, sample size limits the scope and the number of categories we can segment the market into, because one thing that you have to be careful about is that you need a large enough sample size of funds in order for your findings to be statistically relevant and significant.
Yeah, so I want to get back to what you had said about selection, because that's a very important part. I'll just keep that question on the side. But first of all, obviously, congratulations on 20 years of the SPIVA. That's really a great achievement. What have been the key takeaways so far in this really long journey that you've had? You said you started from one region, and here you are now. You said 9 regions. I don't know how many countries those would be, and how many asset classes those would be, because there would be fixed income, there would be commodities, there would be equities, the whole lot of stuff to track. What are the key takeaways for you so far?
So the key takeaways across regions that we tend to observe is that first of all, short-term results can be volatile. So even in the largest categories, which is the US large cap equity, which that is our flagship category. Over the past 21 years, there were 3 years out of those 21 when actually a majority of active managers did outperform. There are also periods where they have very high underperformance rates. So in the short term, it moves around quite a bit, underperformance rate. But another important finding that is relevant across the board is that over the long run, if you look at performance over 5 years, 10 years, in the case of the US, 20 years, the vast majority of funds underperform their benchmark. In the US, where we have the longest history, if you look at 20-year statistics, every single category that we report on has an underperformance rate of 90% or above.
Wow,
so a very big majority of...
that's painful, okay.
Yeah,
please go on,
and that's the reason for that is that many of the long-term drivers for active managers' performance are getting more pronounced the longer the time horizon we look at. So they kind of add up, compound, like year after year after year, and over 20 years they are the factors that really dominate the underperformance rate of actively managed funds.
Very interesting. So India is still a relatively young market when you compare it to the US, in terms of age, in terms of liquidity, in terms of depth, and all those factors. Now I want to go back to the point that it made about why it's important to be careful while you're selecting which index and which benchmark you are comparing the performance with. Can you just explain to us what you meant by that?
So what I meant is that in order for you to make a fair assessment about the performance of any active managers, you have to compare the performance for what is the universe that particular manager selects stocks from, what is the style that he follows, because in order for the comparison to be fair, you have to take into account the risk profile. So obviously it's a completely different proposition to invest in small cap growth stocks in the US than to large cap value stocks. The former one is much more volatile, much more risky. The risk of long stretches of very volatile underperformance for that index is much higher than in established large cap value names. And that's the reason that you need to compare apples with apples, basically.
And people kind of tend to get a little bit carried away in their comparison at some points of time. Benedek, you know that passive investment has boomed in India. The largest, I would think, mutual fund in India today is, in fact, and the SBI Nifty ETF, I think, which tracks the benchmark Nifty index. Does this trend in India look similar to what's happened globally?
Yeah, absolutely. So we saw this trend really take off first in the US in the 1970s. That's when early 70s was the birth of the indexing industry, and it was really an innovation that was driven by academic research that it is very hard to outperform the markets for active managers, because we are by no means the very first provider or researchers that had made this observation. Already in the early 30s, so almost 190 years ago,
Wow.
Alfred Coles in the US, for example, came to that same conclusion looking at the performance of active managers.
1930s.
Yeah, I think 1932
Amazing.
was
Amazing.
the publication of the first relevant research, at least that we could track down in our team.
Okay.
And the advantages of indexing has become more and more apparent to a larger and larger investment community.
Sure.
First starting in the U.S. and then spreading in the rest of the world. And also the structure of the markets changed fundamentally. And that also was a big tailwind for index investment and index investing. And what I mean by that, when I say that the structure of the markets that changed, is that the share of professional investors have increased tremendously at the expense of small-time individual traders. And one of the three key drivers of performance for active is exactly the level of professionalization of the industry or of a given market, because the higher the share of professionals in any single market, the harder it gets to outperform. And to understand that, what you have to consider is that in any market, the alpha of one player can only come from the underperformance of other players, because in totality, all actors or all participants in the market, by definition, own the market as a whole. And if it's all professionals competing against each other, then the ability to extract alpha from another very well trained, very hard working player who has access to instantaneous information, just like you are, gets increasingly difficult.
Yeah, I see that happening in India also, because I would say that, 10, 20 years ago, the number of what we call systematic investment plans and the money coming in from that route was probably zero. Today, it's 2 billion a month. So I'm assuming that when you say that the market becomes more professional, it means that the presence of institutional funds, which are a pool of investments for people like me. Like I put into a fund, the fund invests in the market, versus me directly buying the same shares in the stock market through a broker. So I'm assuming that's what you mean, that once the institutional fund activity increases, the retail decreases, and that's a trend that naturally plays out as markets mature. I mean, do you see that happening in India as well?
Yeah, absolutely. And that's exactly the trend I referred to, that rather than individuals buying their own shares, and because they tend to underperform by a huge margin, they are a natural source of alpha for the institutionals.
Their losses, this guy's profit.
Exactly.
Probably.
That's exactly right.
That's bound to happen. Okay. I want to get into the S&P Dow Jones Indices persistence scorecard for multiple regions. What exactly is a persistence scorecard, and what do the India persistence numbers look like?
So persistence scorecards were launched to answer a question that we often got from investors or from clients who we talk to. So what the proposition tended to be is that, okay, guys, I understand from the SPIVA reports that majority of active managers underperform, but can I not just pick the managers who outperformed in period X, and then they will keep delivering me in subsequent periods? So to answer that question, or to look into that proposition in more detail, we launched the persistence scorecards, which try to answer the question whether outperformance persists over various time horizons. And we launched, again, like just with the original SPIVA report, we launched the first such persistence scorecard in the US, and now we have an official scorecard that comes out for Australia, for Europe. but the coverage is for data size, for sample size reasons, is a narrower one than for the SPIVA report itself. And what we do in these persistence scorecards is that we look at various time horizons of 3 years and up to 5 years, and we look at top performing funds. Various versions. So in one report within the scorecard, we look at top quartile funds. In other reports, we just relax the conditions and look at top half performing funds in period X, let's say in December 2018, and then we observe how their relative performance evolved in the subsequent 4 years, let's say December 2019, 2020, 2021, and 2022. And of course, statistically, there is an expectation that you can form if you assume a random distribution of top and bottom performing funds, because if the distribution were completely random, you would expect half of the funds which were top half funds in one period to still be top half fund the next period, and then again, if it's completely random in the subsequent period, it will be half of half of half, which is 12.5%, and so far. And we can compare the actual numbers and statistics to what we would expect under a random distribution. And what we found across regions is that there is not only not persistence across regions, but there is indication that it's rather mean reversion that is taking place. So it's more likely for a manager that outperformed in one period to actually start underperforming and vice versa.
Amazing.
And coming to India you
please.
asked about, so there are no official scorecards for the region for persistence, but we did make our calculations. And again, I just want to disclaim what follows next by saying that the sample size is fairly small. There are categories with 100 plus funds which are large enough, but there are some others which are which contain 30 or 40 funds only. So you can't. You have to take these numbers with a pinch of salt. But
please tell us,
what we found is that in all but one of the categories, we also found no evidence of skills persisting or outperformance persisting. But there was one bond category where we actually saw persistent rate that is higher than what would be happening, or what a random distribution may assume. But again, due to sample size, it could be a false positive or a real positive. But for 4 of the 5 categories, it is.
And which was the 5th one where there was some?
That was India composite bond category.
Fixed income of all the places. How about that?
Yeah.
Factor investing, relatively new concept in India. So, what is the core of factor investing? If you could just explain that to us. I know that there's something called low vol, momentum, value. Just help our listeners understand this concept.
So to understand factor investing, I think it's useful to take a step back and just speak for a moment about the evolution of index investing in general. So before the 70s, there was really no index industry to speak of. And the first generation came in, as I mentioned, around the early 70s. And the first generation of indices were indices that represented the broad markets, like let's say the S&P 500. And the second generation of investing came around the 90s, early 90s, where indices were brought in to represent a sub-segment of the market, let's say small caps, or the small cap 600 in the US, or different sectors. There are 11 gig sectors that track utilities, real estate, healthcare, and so forth. Yeah. And the third generation of indexing are the factor indices. And as opposed to the first 2 generations, they are not market cap weighted anymore. They are weighted by, and they are constructed by putting together a bunch of stocks which have some common characteristics. So what they are trying to do is to is to represent a subsegment of stocks within the market which share common characteristics, be it low volatility, so a bunch of stocks which exhibit lower volatility than the benchmark itself, or value, which is basically a subsegment of the market that trade at a lower valuation, price to book, price to earnings multiple than the market as a whole. And there are like momentum, quality, growth. So they are all subsegments of the markets that share common fundamental characteristics, and as a result, they exhibit a particular distinct pattern of returns compared to the main benchmark indices.
Each of these is a factor. Could be low valuation, could be low volatility. So last question, if you could just help our listeners understand the case for a multi-factor strategy, right? I mean, why should I be considering that?
Yeah, absolutely. So one challenge when it comes to factor indexing is that these characteristics and the patterns of returns that are associated with any of these factors play out over very long horizons, so across a market cycle, which can be a decade in length. And within that period, there are obviously periods of outperformance, underperformance, and it has proven extremely challenging for market participants to time the periods of outperformance or underperformance for any given factor. And multi-factor indices have arisen because they kind of solve that market timing factor for investors. So by combining multiple factors into one index, the outperformance patterns of that multi-factor index have become much more stable compared to the benchmark index, because most of these factors exhibit low or in times even negative correlation to the performance patterns of other factors. So a multi-factor index tends to be much more stable and offer lower volatility.
Very interesting. Folks, we've done a few episodes on smart beta and factor investing. Just check out the archives for that. And of course, the one question that I think I want to wind up this episode on is, what is the SPIVA report telling us about stuff in India, right? Because we spoke a lot about the SPIVA, but what are the numbers? I believe the latest report is just out. I saw a couple of people posting it on LinkedIn. You just share that with our listeners. I want that to remain as the last thing that they think about once we leave the episode.
Yeah, absolutely. The key findings were really fascinating, although in the main category, which is probably the most important for investors, that is the equity large cap category. The underperformance rate was 58%, which is very close to the 10-year statistics that we observed. So it's close to what we would expect based on long-term statistics. But there were two segments or two categories in particular which produced very interesting outlier results indeed.
What are they?
One was the ELSS fund space, which had posted one of its lowest underperformance rate since we started publishing the SPIVA reports in 2014, as the managers in the category outperformed the market. At least 82% of them outperformed the market in the first half
ELSS,
of
right?
2023.
Equity-linked saving schemes.
Yes.
Wow, 82%.
And when we looked into, when we really dig deep into what might be going on in this category, what we found is that over time, like since we started publishing the reports, there was a systematic relationship between the relative performance of small cap small cap equities and the BSE 200 and the relative performance of ELSS managers. So what we observed is that in any period when small caps, the mid and small cap S&P BSE 400 index strongly outperformed the BSE 200, which is the benchmark that we use for ELSS funds, the underperformance rate tended to be much lower. And the reason that might be the case is that ELSS managers, although their key mandate would be to invest in relatively larger stocks. They venture outside that universe, and they tend to take exposure in small firms as well. So when small firms do well, ELS's managers tend to do well, and vice versa. When the S&P BSE mid small cap index underperforms the S&P BSE 200 index, then ELS's managers' underperformance rates rise.
Man, I didn't expect that at all. Huh? I mean, the BSE small cap, the BSE 200, and the ELS's category. Those three were there's some link out there between the three of them. Interesting. Okay, folks, that's the main part of our show. Our last and standard question to Benedek: what book are you reading? And do you have any recommendations for our listeners?
Yeah, absolutely. I'm the ultimate bookworm. So
nice.
I had quite a few nice readings over the weekend.
Go for it, eh?
And over the summer. So one fascinating read, which is I think particularly relevant for your listeners, is Edward Chancellor's The Price of Time, which looks at the history of interest rates over the past 5 millennia. It looks at how interest rates were born, how they were computed, what the impact of interest rates were on economies, on societies over the past 5,000 years. So now that we are entering probably into new interest rate regime, higher for longer, for demographic reasons, for reasons that are related to the investments needed for energy transition, I think it's a particularly eye-opening read.
Is he your favorite author? Because I would read anything he writes. Edward Chancellor is like up there.
The Capital Return is also an excellent book and very eye-opening. How the supply and demand for capital drives capital cycles across industries. So I really enjoy that.
Okay, so that's book number one is Edward Chancellor, Price of Time.
Yes.
What else do you have for us?
That's right. Then a fun read, which is not finance related, is Robert Pirsig's The Zen and the Art of Motorcycle Maintenance.
Are you serious right now? I mean, Robert Pirsig and Zen and the Art of Motorcycle Maintenance. I have not had a guest say that, but wow, what a choice. I mean, have you reread it? Because it's a book that I keep on coming back to. I read it in college, like way back. It just blew my mind apart. So,
I reread it for a second time.
It's very deep,
very deep, but it's also it's very easy to relate to, and whenever I read it, I just always decide that once my children will be old enough, I will make that same road trip in the Montana mountains where this whole book plays out. So that's another one.
Can't go wrong with that book.
And the science one is which is really light-hearted and gives a lot of it's just radiates the joy of life and the joy of discovery. Is Surely You Are Joking, Mr. Feynman by Richard Feynman, which which gives a glimpse into one of the biggest scientists of the 20th century.
Feynman, Surely You're Joking, Mr. Feynman.
Yes, and he has a couple of other books, but Surely You're Joking, Mr. Feynman is probably his best of the bunch.
I would love to have, you can share a photo of your bookshelf with our listeners. I'd love to have that photo, really. Look at that. I mean, number one is the Edward Chancellor, Price of Time. Number two is Robert Pirsig, Zen and the Art of Motorcycle Maintenance. And third is Surely You're Joking, Mr. Feynman by Richard Feynman. Amazing.
But we can go next time. We can have a podcast dedicated to books. I'm happy to do that.
I should be talking with your firm about setting up a separate books podcast just with you. But on that note of awesome books, folks, that is a wrap on this episode of Paisa Vaisa. My guest, Benedek Boros, Director, Index Investment Strategy at S&P Dow Jones Indices. Benedek, thank you so much for doing this for our listeners.
It was an absolute pleasure. And I look forward to being back.
Yeah, and we look forward to having you back, and have a great time in India.
Thanks very much.
IVM.